everyone here, Chris Caprice, SecondsGuysForex.com. So this is the second part of the video series for this weekend here, and this one is on central bank intervention. The reason why we're talking about this is that there's been a lot of talk and whispers about it in the market lately. I've seen a lot of articles about, there's rumors of RBA or Royal Bank of Australia intervening in the market, and that they were checking FX rates and smoothing things out and things like that. And so we're going to talk about that. The market has been exceptionally volatile as of lately. We've seen some kind of surprising moves in the markets, and some of them, are quite powerful. So we want to talk about that, how you can, trade that, how you can avoid getting caught in the crossfire of that, and so forth. So one of the most recent ones is the euro dollar. Euro dollar has been selling off for quite a long time, since 3,100 down to just shy of 2,100 here. So about 1,000 pips, very aggressive, very consistent, small pullbacks here, here, a couple pullbacks here, a nice little corrective flag here, and then boom, down. But then all of a sudden, as we zoom in, we can see that it got exceptionally bullish out of nowhere. It's just incredibly interesting candle here. And, usually when a central bank intervenes into a market, it produces candles that don't produce any lows. In other words, they open and they just take off. And that's what we're seeing on two separate candles here. We see this candle here that has absolutely no low, just shoots up, closes very close to the high. And then we have the second candle here that just opens, shoots up, closes very close to the high as well. And so there was a lot of speculation that the ECB might be intervening, which is actually kind of silly because the euro is only about 1,000 pips away from where it originally started at, more towards normalized levels, which is 115. So that's a more normalized equilibrium for the euro. So it seems very unlikely that they would intervene here. Central banks generally intervene at huge extremes. They knew the euro was overvalued at 150, 160. And, I can see them intervening at, maybe parity, maybe 80 cents. But I cannot see them intervening very close to the mid-range for this pair. So there was a lot of talk about, hey, did the ECB intervene? No, they didn't intervene. Actually, what happened was, and let's take a note of this real quick here. This move happened right here at 6 a.m. California time, and then this one here at 11 a.m. California time. What actually happened had nothing to do with the ECB. They're busy with other projects right now. What happened was the Swiss National Bank had intervened. And so here we can see, this is normalized price action movement. You can see the average movements here. But then take a look what happens once it gets to 140 here. It gets to 140. All of a sudden the price action gets incredibly artificial. Very artificial here. And, the euro Swiss is losing ground. That means the Swiss franc is getting incredibly strong. And they don't do well with an incredibly strong Swiss franc. It's been getting way too strong against a basket of currencies, and so it's been affecting their economy. And what we see is this incredibly artificial price action here. The market was selling down for 300 pips, but then it just stopped, and it was stuck in a 30 pip range for 6 days. That is artificial. So what happened was the market was trying to sell it, and then they kept running into these orders here. And what that was is that was the central bank holding it here, and then once they had absorbed all those orders, they come in and they shoot the pair up. And so what happened was is that they weren't buying Swiss francs, they were buying euros and selling Swiss francs. This was the pair that it was most oversold against. And so what happened was is that they sold Swiss francs against the euros, the more natural currency to do this against. And so look what happens. Take a look at this candle. Opens, virtually no low, shoots up 200 pips, which is abnormal since this pair only has a 50 pip range on any given day. Shoots up 200 pips in 1 hour, closes towards the highs. Settles back a little bit, and then again, same candle formation, no low, shoots up, closes towards the highs. Now let's take a look at the exact same time that these things were posted at, 6 a.m. California time and 11 a.m. California time. So what happened was is that the Swiss National Bank sold Swiss francs, bought euros, and that in turn pushed up the euro itself. So, maybe you got caught in the crossfire in the euro there. You were selling it, you were making money, you were selling it, making money, you were selling, making money. All of a sudden the pair just shoots up out of normal. And so this is the importance of having stops in place. If you have stops and have your risk fixed at the outset, 2%, 5%, then when you lose on these trades, maybe you were shorting euro all that time when it was falling from 131 to 121, making money, but then as it went against you, all of a sudden, you got taken out. Well, if you had stops in place, then that loss is like no other. Or the loss is just like every other in the sense of it's just 2%, it's just 5%. You start risking 10, 20% of your account, you start shooting for the moon, And one of these little trades could take you out huge. If you have no stop in place, which is something that no professional trader does, if you have no stop in place, then you can lose massive amounts of your account in just 1 hour when the central banks intervene like this. This is what central bank intervention looks like. And so because of that, it has affected the euro-dollar immensely. Now, there's also been talk of the Australian dollar having intervention. Now, this thing has been selling off since 9,000, went all the way down to 8,100, 900 pips in a matter of 6 days. Pretty drastic for this pair. And then the pair started to bounce a little bit here. The thing about it is the same time that the rumors are coming out on the ECB, and the Swiss National Bank and all this intervention here, they were saying the same things about the Australian Central Bank. To me, this is very odd because this doesn't look like central bank intervention. It looks like short covering on the rumor of central bank intervention, but if the central bank intervened, it seems like it'd be a much more forceful move. Don't get me wrong, 6 hours in a row of buying, 6-7 hours in a row of buying is, solid, but it only moved up 200 pips over 7 hours. That's not too far out of normal. I mean, this thing had dropped 200 pips in 4 hours. So to do it in 7 seems like, okay, this doesn't seem like central bank intervention. A lot of articles are saying that. They're talking about the whispers of it, rumors of it. Honestly, I just don't buy it. In fact, normally or historically, when the RBA has intervened, they've done so via, the 70 level, the 60 level. They've never come in at the 80 level. They wait for the much more extreme highs or the much more extreme lows, and we're not too far from the extreme highs of 9,400, which was the 08, 09 highs for this pair. So, the bottom line is that we're not really there yet. So I highly doubt the Australian Bank intervened. It does look like it's short-term supported here. It does look like it's going to challenge us here. But the bottom line is this is not what an intervention looks like. So I wanted to, explain this here so that you understand the two differences between what an intervention looks like, what it doesn't, how to avoid taking big losses on that, and then how to trade it is very simple. Going back to our ECB situation or with the Euro Swiss, what you do is you wait for pullbacks after the first initial push towards the 20 EMA. This one maybe didn't work out so well, but look at this one here. It pulls right back to the 20 EMA, and it just holds right here. And take a look at this here. On the 21st, the Dow was selling off to start off with, and yet this thing is supported. All rejection candles here. All rejections. Dow's selling off, and this thing's supported here. And then what happens? Continues to find higher ground. Same thing with the euro. Take a look at this here. Dow starts selling off 150 pips right at the open, and look what happens. This thing's being bolstered up. Look at all these rejections here. Same thing here. This same day, the Dow was selling off 376 points right when this was happening, and look at all these wicks. It's not going anywhere. It's going sideways. That's because the central bank was involved in the market. They're supporting the pair, and then they sent the pair back up. So that's how you trade it. You trade in the direction of the intervention, obviously. Try and get in close to the 20 EMA on either a 1 hour or 4 hour time frame. That's the most normalized way to do it. The EMA, the 20 EMA, and all time frames, particularly 1 hour, 4 hours, and dailies, tends to run a sort of, or represent a sort of equilibrium. So it gives you a chance to get back in there. Give it a little bit of play, just so it can, move past it. But eventually it's going to find its way up higher past that. So, if they intervene once, the pair probably isn't just a one and done. It generally will find another situation like that. So that's how you can relate to these. That's what interventions look like and what they don't look like. Hope this video helps. And so if you have any questions, want to learn some rule-based strategies, check out our Pro Forex course, our Advanced Price Action or Ichimoku courses there. And if you want to find out how to get a discount, email me at info@secondskies.com. Until then, good luck trading. We'll see you next time. Take care, everyone.